Okay, it looks like we've got a lot of people on board, so we might just kick this off. Can everyone out there hear me quite well? Just give me a thumbs up. Great, thank you. All right, hello there, everyone. For those who don't know me, I'm Simon Prowse. I'm a director here at Navwealth and particularly in the accounting team. And today's session, we're going to be talking about tax planning and making a success of the end of the financial year from the point of view of taxes and accounting. I'd like to introduce my team to you today for our talk. Firstly, I've got the Director of Professional Bookkeeping, Hayley Kalms. Hi there, Hayley.
Hi, Simon. How are you?
Then I've got Hugo. He's our Accounting and Business Services Manager. Hi there, Hugo.
Good afternoon, everyone.
And then one other of our business services team, Julian Hui. Hi, Julian.
Hi, everyone.
Just a little bit of housekeeping before we get into our session. Today's agenda, it is quite action-packed and there's a lot on that screen. More particularly, we'll cover quite a lot of these areas and we'll do it at quite a high level. However, when we do put this recording out there, we will make a white paper available, which will have some questions for you, whether you're a business or an individual client, that'll take you for a bit of a deeper dive into these areas. So fear not, there'll be stuff that we cover fairly quickly and there will be some more detail in the white paper that you can refer to at a later point. Okay, now what we're going to do with our talk, there'll be no doubt a fair few questions from our audience and people out there as we go through it, and we're going to go through it fairly rapidly. So what we'd like to do is, as you come up with any questions, please add them to your chat box in your webinar. And what we'll do at the end of the session, we'll review these questions and we'll look to identify those particular ones and hopefully cover anything that you have that comes out of today. So we will cover it, but we'll do it at the end. Okay, tax planning. I liken tax planning, it's a bit like any planning. And a good example is if we want to go on a car trip and we want to get up to the Blue Mountains and we've never been there before, well, we tend to plan it. We'll either, look it up on our sat nav or do it on our computer, and we'll identify the map or the way we want to get there. Tax planning's very much the same. If we take a little bit of a step back and look at our businesses and look at our circumstances, we can really get a lot out of tax planning that essentially will get us there and get us there in a way that is planned by us rather than being the servants to what tax outcomes look like. So I'd encourage you all to have a bit of a look at your circumstances. And with Navwealth and what we do, we tend to drive a little bit of personal and business planning in the same process. Well, a lot of us set our New Year's resolutions and our goals at the beginning of January each year, and generally it's after a few drinks. But at 30 June, us accountants, we love to plan for the next 12 months because the end of financial year is our reset time. So again, I'd encourage you to take a look at your personal or your business plan and review those numbers and what you want to achieve for the next 12 months and what it might look and feel like. It's a really good time to really just, take it all in. Okay, so first I'd like to introduce Hugo. We've said hello to Hugo at the beginning, and Hugo, our business services manager, is going to look at the macro world and what's been going on and with the tax man and things that are happening out there. So Hugo, there's a little bit of information that's been coming out of the ATO in recent weeks and what's going to be on their spotlight and what they're going to be reviewing for businesses and individuals. Do you want to take us through a bit of a walk through there?
Yeah, thanks, Simon. So look, the ATO has flagged some key areas that they're looking at for this current tax year that we're in. The first one is work-related expenses, and this mainly relates to claiming home office. So the ATO has a set rate where for every hour you work at home, you can claim this set rate as a deduction. That's currently 67 cents per hour. In the past, that was 52 cents. and it basically covered things like electricity and gas and depreciation on the home. In 2023, they increased the rate to 67 cents, but it also now includes mobile phone and internet. So if someone's out there and they're claiming, they want to claim the home office rate, they can't also claim the internet and mobile phone costs as well. It's essentially doubling up. So that's something that they've caught people out on. The next one is rental properties. I think this is always on their list every year. What they're looking at now is secondhand equipment or furniture. So when it comes to a rental property, you can only claim furniture and equipment on new equipment, so it can't be secondhand. Secondhand items are just straight up not deductible. The other thing they're looking at is repairs. I think this is an ongoing issue. So care needs to be taken when claiming repairs, as often repairs can be an actual improvement to the property. That simply means that they can't be claimed as a one-off deduction and they have to be claimed over time. So having a large repairs claim in your tax return, that will probably trigger an ATO audit. They're also looking at people who are failing to declare all their income. I think this stems from people relying on the ATO having all their information, their income information there. So typically what happens is if you have given your tax file number to your employer or to like an investment, that income goes through to the ATO and it's pre-filled in your tax return. But it's not instantaneous on 1 July after the end of the financial year. It actually drip feeds over time. So I think some people are jumping the gun and they're lodging their tax return in early July, and it's missing a whole bunch of information. The next one is Division 7A. Just a bit of background on this one. It's also known as a director's loan or debit loan. I think the simplest way to explain it would be that a related party of a company can lend money to a company, but it can't borrow money from a company. So there's tax consequences there. And the idea behind that is the legislation kicks in to stop people from using company money and essentially avoiding tax. So at the moment, the ATO is running an education piece on Division 7A, and I imagine there will be some audit activity to follow after that. So one of the key things they've sort of highlighted in their education piece is when people borrow money from a company and then they quickly put it back before the end of June, and then after the financial year, they pull it out again. So on the financial statements, it looks like that loan wasn't there, but they've just put it in and pulled it out pretty quick. So the ATO will sort of look at that transaction and just call it a sham transaction as if it never happened.
Hugo, thanks for that. I understand with the ATO under the microscope, this is the data matching. There's a lot more information out there. Rental properties, and it's one of those things we've seen a little bit of. Tell us a little bit about what the ATO is doing on the interest and where that's going with deductions.
Yeah, so look, when people borrow to buy an investment property, it might be from a loan that already existed. So it might be that they just increase their loan limit, or they've got a loan that has multiple purposes, and they're just claiming 100% of the interest on that loan in their tax return against their rental property income when it really should be apportioned.
Okay, so they're just trying to make sure people are doing fair apportionment to the asset. And that Division 7A, it's a really big area, I think, this year. What are you thinking? The ATO are really telling us they're going to ramp it up?
Yeah, definitely. So look, with those campaigns, like there's a reason why they do it, and that's to educate you so then they can catch you out.
Yeah. Thanks, Hugo.
All right. There are a few things that coming up to the end of the financial year we should be aware of, and these are changes. First one being tax rates for individuals. So, and this is all good news. The 19% tax rate is dropping down to 16%. The 32.5% tax rate is dropping down to 30%. There's actually a few changes in the bands, so in the marginal rates. The biggest one being the the top marginal rate threshold is increasing from 180,000 to 190,000. Super guarantee, the rate is 11% this year, but that's jumping to 11.5% next year. The concessional contribution cap. So concessional contributions are those contributions which you yourself are claiming as a deduction or your employer makes and they are claiming as a deduction. The cap is currently $27,500 and that's jumping to $30,000. The non-concessional contribution cap, which is the contributions where no one claims a deduction, that's increasing to $120,000 from $110,000. That also means that the new bring forward, the 3-year bring forward, is now $360,000. So one thing we should highlight though is if you haven't used your concessional cap completely in the last 5 years, you can actually go back and use it this year. So you can sort of bring those forward and claim that deduction this year.
Hugo, on that bring forward, is there any limit on the amount you can actually claim and based on a super balance?
It's just a 500,000. Your super balance has got to be under that. So your total super balance has got to be under 500,000. And the limit is just your cap every year minus what you've already claimed. So it's just whatever's left over in those last 5 years, you can claim this year.
Which is a great thing because you can catch up for those years where the money would have probably been tighter and you haven't had that capacity. It's nice that the individual rates are dropping too. Sorry, Hugo.
No, that's all right. So look, well, when it comes to making voluntary contributions, we always say talk to your advisor first because there's a few things there that you might not be aware of.
Great. And then the individual rates are dropping. It's been a while, but we're seeing a small change in the landscape. So that'd make sense to defer income or put things off till next year because the rates will be lower, yeah?
Exactly. So look, that's kind of working against these interest rate rises we've had recently because that's going to put more money out there. I just hope it doesn't mean another rate increase next year.
Yeah, fair call. Thanks, Hugo. That was great. Now, Hayley, as a professional bookkeeper, you're a busy lady when it comes to 30th of June. Now, various bodies these days are getting reports from businesses and activity, and particularly the ATO. And it seems like they're forever putting dates and stamps on things that need to be done that 30th of June. So do you want to take us for a bit of a walk through the end of year prep from the bookkeeping point of view?
Yeah. So more and more the ATO these days, everything's online these days. Everything needs to be reported, usually through some sort of platform. So you can't get away with not reporting on time. But what I first thought I'd do is take you through a few sort of tips to make your financial year sort of seamless. So it helps you gather this information that you actually need to do this compliance work effectively for the ATO. So start early, start getting organised. So as bookkeepers, we're continually working on our clients from month to month. But if you don't have yourself organised or you feel like you don't, start doing it now and document everything. So just start collecting every receipt, every email. That doesn't only assist us, but it also assists your accountants. And it also can assist if you have like future audits or anything like that as well. And utilise technology to do this. So if you don't have Xero or some sort of other platform, maybe think about getting that for yourselves, even if you are an individual, because that can really help gather all this information. It can automate all these tasks, helps you reconcile, helps you reduce your errors in reporting and makes more accurate reports for all of us to use as well. And also you said, sorry, this is the perfect time as well to review your accounts. So go through, utilise that Xero, and then go through all your accounts before 30 June, and then check in with your accountant. And as you said before, plan for the future. So plan with your accountant how you can start doing all these processes, and then plan for going into the next financial year. And this will all help with the next few things. There are a few key dates and tasks that you can use this information for. So the first thing, superannuation. So really important, if you can and your cash flow allows in your business, to pay all your employees super by, we suggest June 30, or as soon as the last payroll is run in June. And then that means that you can actually sort of claim that expense within that financial year. If you leave that as a payable at the end of the financial year, it can't be claimed as an expense. It'll be left for the following financial year to claim. So it's a good idea to do that. And also, if employees have asked to put extra super away for their own personal tax purposes, it's really important that you get that in for them. So really try and do that by the 20th of June for them too. So it hits their super funds before 30 June. If cash flow allows, again, make any payments if you can for large purchases, or clear your creditors out by 30 June as well, especially if you're on a cash basis, because then you can claim those expenses in the current financial year. And it also decreases your GST payable as well on your final BAS for the year. Also, do a stock take if you've got any inventory. Try and do that on this year. It's the Friday, June the 28th is the last business day. But if you're still trading 30 June, which is the Sunday, try and do a stock take as close as possible. And same with your petty cash. If you've got a petty cash or a cash till, if you're sort of in that sort of industry, try and do that close to 30 June as well. That all helps us and your accountants prepare your more accurate reporting for you. And then by 30 June as well, if you can provide, or after 30 June, provide any bank and credit card statements to your bookkeeper or your accountant, and any lease paperwork. So anything that you've purchased during the year. If you can do that, just the first week of July, that all helps in preparing all these reports and finalising your compliance for the ATO.
Hayley, one thing that you mentioned there that's pretty important is the old super. Because of the clearinghouse and so forth, you're suggesting that it's paid a bit earlier. Take us a little bit on that, because if I'm paying a bill at the 30th of June, I'm paying the bill.
Yeah, look, from an accounting point of view, when the cash comes out of your bank account, it's paid usually. We're finding, and we've found this in the last few years, it takes a while to clear through these clearinghouses, and it's not actually hitting your super fund until after 30 June if you don't pay that in time, because there's a bit of a backlog. And that's what the ATO are actually looking at, is when it's actually hitting your super fund, not actually when you've left your business bank accounts.
Oh, that's really important. So it's got to hit that super fund. And importantly, for those people with salary sacrifice, if it doesn't hit their super fund, you could actually prejudice them for the next year, because obviously it'd be a contribution for the following year rather than the year in question, yeah?
Yeah, correct. So you've got to really be mindful of that with your employees. Yeah.
Great, thank you.
Okay, so another few key dates that we need to be aware of after 30 June. One is your wages. These days we call it preparing your final event by the 14th of July. As we all know, if you're preparing a payroll, it's usually done through single touch payroll these days. So the ATO are getting a regular recording of your wages every time you run a pay run, but this has to be actually finalised so the total's finalised, your old payment summaries per se, by the 14th of July this year. So if you have any troubles with doing that, you can just contact your accountant or bookkeeper to help you with that. The next one was the super, with which we've gone over the super contributions and timing and making sure that you paid it in time. But we need to be aware going into the next financial year, there's an increase of 11.5% of your super contributions. And there's a little bit of a timing there. I think I've had a few questions from clients about, what if I process a payroll in June or for a June period and then it's paid in July? Am I paying it at the 11% or the 11.5%? And the important thing to remember with payroll is it's based on the date paid. So if you're going to pay that payroll in July, then yes, the new 11.5% will apply. But if you're paying a June payroll in June, it's still going to be at the 11%. Okay. Now, there are a few other reports that are also due for lodgement and for compliance. This one's been around for a while now, and usually for the construction industry, but there are a couple of other industries as well. So the taxable payment annual report, and this basically is a report for any contractors that are providing labour for you, maybe on your site as a builder. Usually this is really important why you should have a Xero program or a finance sort of software so that you can keep track of these contractors. There's a way of keeping track in those softwares so you can easily run a report and lodge that to the ATO online by the 28th of August. So, but we can help you with that.
Yeah, that one's an important.
Yeah. Sorry, Simon.
One. Yeah, sorry, Hayley. That one's an important one because it seems the ATO extending that net for catching those businesses that are employing contractors, so they can get a lot of information coming out of the business rather than the contractor itself. So it seems to be a data matching campaign as well.
It is, and it's very important. The ATO will ask you if it's overdue, so that they do think it is quite an important report. So it is important that you do that report, even though it's not really about you, it's about your contractors. It's still important to lodge. Okay, so there's another new report as well that I just wanted to highlight that it does affect some of our clients. It's called the Sharing Economy Reporting Regime. So this is a new reportable report for anyone that does business through an electronic distribution platform. So this could be for taxi travel, the ride sourcing, or short-term accommodation. So, like your Airbnb and Stays type platforms. You're going to need to, each year by the 31st of January, report all your sales made on that platform between July and December. And then from your sales made from January to June, that's going to have to be submitted on the 31st of July. So that's from the 2025 financial year moving forward. For the 2024 financial year, you actually have to report on the total year by the 31st of July. And then you'll move to that every half yearly. And the 2024 financial year, it is only for short-term accommodation, taxi travel and ride sourcing platforms, but that's actually going to increase to a number of other platforms in the 2025 year. So reach out if you do business on any of those platforms and any sales. And then there's one other new report that I wanted to highlight as well today. This is reporting for non-for-profits. So from 1 July this year, if you're a non-for-profit with an active ABN, you will be required to lodge a new annual NFP self-review return to the Australian Tax Office to confirm your income tax exemption status. And this can be submitted anytime between July and October. There are a number of criteria that you have to fit to have to do this report. So you need to check in with your bookkeeper or accountant if you are involved in a non-for-profit, certain government entities, if you're registered with the ACNC, if you're registered for GST, you could be excluded from doing this report. So you just need to check in with your accountant or bookkeeper on that one. But it is another report that's important. All right, so I also just wanted to go through a couple of common issues and areas that we find as bookkeepers if a client is doing their own finances. The main issue is miscoding. So miscoding to general expenses, miscoding your GST, not reconciling correctly, which might overstate your income or your expenses. And this really gives inaccurate reporting for accountants. Another one is FBT coding, like making sure you code entertainment and other expenses correctly for FBT. This actually causes time for us to go in and fix. So you just need to be mindful about that miscoding, which is another reason why you should really have a bookkeeper doing your accounts. So to ensure the accurate reporting at the end of financial year and for your accountants when they're doing your tax returns. Another area is payroll. A lot of people do get payroll incorrect, looking at award rates, termination pays. A lot of people aren't unsure about the tax implications on termination pays. And single touch payroll, people don't realise you actually need to process that on the day you pay. Otherwise, you're not being compliant with the ATO. and then that affects your final pay event, as we discussed before. So payroll is a very, you could call it a messy sort of function that, yeah, a lot of people do get wrong, and it's really important, I think, to have a professional look at that and making sure you're doing that right for your staff. And the main thing is people not doing or having their accounts all up to date. So you're missing these deadlines and you're missing these compliance reporting requirements because your stuff isn't up to date. So it's really important to try and keep everything up to date so you're not missing these deadlines. And as I said before, the ATO know when you're missing these now, everything's online, and they'll be in contact to ask you why.
What a minefield, Hayley. I can't believe the compliance now probably in the last sort of maybe even less 5 years, this regime is just taken a quantum leap forward. Again, if we're not running software, are we crazy trying to maintain our business? What would you be saying?
Crazy, because you need software to lodge most of these compliance reports anyway. And because there are so many now compliance requirements for businesses, you really do need a software program.
Yeah, I mean, I'm looking at this. There's probably 4 or 5 regimes for reporting between sort of the end of June and mid to late August that you've got to get right. So it could be really dangerous if you don't have the right information.
Yeah, exactly. That's why it's really important to get organised and just have everything ready to go, and then you won't miss anything.
The world of bookkeeping, you guys are doing so much these days, and I suppose that's why we're calling you the professionals and the CFOs of the organisations, and much needed. So thank you.
Yeah, thanks, Simon.
Well, Julian, we'll just bring you into the equation now, and with regard to sort of tax planning, and Julian, as I've introduced you, is part of our business services team. Now, Julian, you're going to take a bit of a deeper look into some of the key areas that we can do for tax planning. So why don't you sort of give us some of those bits of gold, if you like?
Thanks, Simon. Look, oh, we've all worked hard throughout the year. We've earned our profit. It's time to look at our profit as year as a whole and just try and minimize tax, trying to pay less to the taxman if you can. So I'm just going to go through the key areas of how the strategies to minimize your tax. Some of them we've gone through with Hugo and Hayley, but those ones I'll skip quickly, but the rest we'll just go through one by one. As mentioned by Hayley, pay your super before 30th June. It's only tax deductible when it's in your the employee's super fund before 30th June. One thing really overlooked is, reviewing the year and work out, wages to directors. Should we, declare wages, look at your profit? If if there is capacity to pay wages to yourself, utilize, your lower tax-free threshold, marginal tax rate, sorry. This year, the ATO introduced a interesting tax deduction or tax incentive is motor vehicles. If you providing motor vehicles to employees, electric vehicles in particular, these are now FBT exempt. So you can provide a benefit on that vehicle to your employees, and you don't have to pay any additional tax FBT on that.
So Julian, on FBT, for those out there, what does that mean essentially? You're paying gross dollars. How does it work?
That's correct. It's pre-tax. You can package it as part of your salary packaging and utilize pre-tax money instead of post-tax money, where if it's a non-electric vehicle, that's normally what happens. So you save really tax for your employees and yourselves.
So those on a marginal tax rate of 30% are saving 30% on the cost of running a car.
That is correct. Keep in mind, these also includes costs of running that car as well. So those are regos, repairs and maintenance, all included in FBT exempt as well. So you save tax on all that as well, not just the purchase. and just minimize tax and just delay that tax a bit for next year. You might want to defer your invoices the next financial year if you can, if possible. Depends on obviously the customer. Some like it before, so to have a discussion with them. The other side, you know, expenses. Try to, you know, if you need to buy consumables or stationery or printing, just general business expenses, try and bring it forward if you can before 30th June, just to get that deduction. There's salary packaging involvement with that as well. So if you want to do that, you can try and do that before 30th June. That way you save tax for your employees as well and save GST actually as well. Prepayments, small businesses, we are allowed to actually claim a deduction for prepayments up to 12 months in advance. So this includes, you know, subscriptions, insurances, rent, you know, try and prepay that if you can, just to before 30th of June, so you can get that tax deduction earlier. Asset purchases. Over the last few years, we've got, you know, a threshold where we can immediately deduct, you know, asset purchases, you know, equipment purchases for business use. Well, this year's 20K now, so 20K, it's gone down to 20K. So if you can make those purchases before 30th June, please do so. Please keep in mind it has to be ready to use and installed before 30th June, not just the payments. If you're doing repairs and maintenance, try and get that done before 30th June as well. Next one, stock take. Mentioned by Hayley, you do a stock take, but there's also a little neat trick in there is, you know, go through your stock take and just write off any obsolete or damaged goods that you're not going to sell. So there's actually an interesting boost available this year, which were actually last year as well. Skills and training boosts. So small businesses, you know, if they get a 20% additional boost on spending to train your staff and increase their skills up to about 100K. So if you're spending, for example, $100, you know, they automatically give you a 20% bonus and you claim a $120 deduction. That ends 30th of June 24. So please utilize that as you can. It's not available next year anymore. Keep in mind, it has to be registered with the government, national register, they call it. So please review that before you do any spending, or otherwise it's not taxable. Okay. Another incentive this year is small business energy incentives. So small businesses have, again, a 20% deduction boost for purchasing energy efficient. Lastly, look, Hugo's already mentioned this, but Division 7A, we make sure you have to meet your minimum repayments. So every year if you have an old loan and you have to repay it every year, there's 7-year repayment. Make sure you satisfy that. You can't just bring in from as Hugo mentioned, repay that using your home loan or in your offset account. Can't just bring it in. So make sure you pay it somehow. Usually it's for declaring salary or wages, or declaring a dividend, or actually using cash that you have and just repay it. So that's for businesses. There's points to consider for individuals. Again, you know, maximize your super contributions if you can. You know, that's including your spouse and yourselves. Investment properties. So, you know, if you made a purchase an investment property this year, it's always a good idea to, you know, engage a quantity surveyor to get those depreciation reports. Any investment properties, try and get, you know, all your repairs and maintenance you have to do regardless anyways. Just try and do that before 30th of June if you can. That would obviously minimize your tax again. Work-related deductions. So try to incur, you know, if you're spending, you know, self-education costs, you know, your training for yourself, you know, subscriptions, work-related reference materials that you need. Try and incur that before 30th June. ATO will be focusing on motor vehicle logbooks this year. They've seen quite a fair few of individuals claiming a lot of motor fuel expenses, so they're going to dig down on that. So try and just get a logbook ready, and then you can claim those percentages. Keep in mind, new vehicles, you need to start a new logbook for a 12-week period. So just keep a logbook for 12 weeks, okay? Keep in mind, home to work travel, unfortunately, is not tax deductible. But if you do travel between workplaces, you have to see clients, count those, okay? Home office. So there's two methods. There's actually there's an actual method and there's a fixed rate method. The fixed rate method, the ATO wants us to keep a log, a reasonable estimate as well on, actually not reasonable, a timesheet. Keep a timesheet on when we actually work from home, how many hours we work from home, the actual dates. Just keep a very detailed timesheet, okay? Travel expenses, we do have travel expense. If you do have travel for work, you do have to keep a logbook if you travel over 6 days overnight. You have to also keep receipts of your travel expenses, meals and hotels and all that stuff. So please keep very good detail on all that. The ATO will ask for it if you do have an audit, okay? And any donations, if you're considering donating to any charities or deductible gift recipients, please do so before 30th June to minimize your tax.
Thanks, Julian. And most of this is in those checklists which have been supplied with the white paper. So you'll take a deeper dive into these areas and provide a bit more of an outcome-based solution for anyone that's looking at to maximise the deductions for the year end.
That's correct.
Thank you, Julian. Now, what we might do is jump into the Q&A and just get a bit of feedback from the audience and just sort of try and cover a few of these. And what I'll do is I'll look to get a few of these questions and then I'll probably just shoot them to you guys as it suits. The company money, I've got a question here. A company money sitting in my personal bank account towards the end of the year, was this account towards Division 7A? Hugo, I might throw that in your court.
Yeah, no problem. So look, the way I see Division 7A and loans is you might have someone who's running their business through a company. They're not paying themselves a salary. What they're doing is drawing money out each month. And then at the end of the financial year, they square it up by paying a salary or a dividend. Like the ATO doesn't have a problem with that because you're taking care of it at the end of the year. What they do have an issue with is, there's 200 grand cash sitting in a company. They don't pay a dividend or wages and they pull that out, put it in their own bank account, put it back by the end of the year so it doesn't look like it's there in the financial statements, take it out again and put it back. And then they keep doing that year on year on year. So that's pretty much what this education piece is trying to get at. The consequence of the ATO finding that and sort of seeing that as a sham transaction is that you'll end up paying, that'll be an unfranked dividend on whoever borrowed it. So if that's the director, there'll be an unfranked dividend that goes in their tax return and they'll pay whatever marginal rate on that. So the penalties are pretty high.
Yeah, so it's pretty ugly. So if I drew money out of the business throughout the year, and let's say I got towards the end of the year and did a bit of a reconciliation and paid it back, and then throughout the next year I'd be drawing money again without sort of putting a mass amount in and out, is that acceptable?
I think it depends on what you're looking at, like what those transactions are about. So if it is 50 grand every month that you're pulling out, and there's a consistent pattern there that you're doing the same thing over and over, I'd say there could be an issue. But if it's just sort of small amounts that you sort of clean up as you go, well, then I don't see a problem with that.
Great, thanks. Another question I've got here is got to do with the payment of allowances, and the ATO has a lot of I suppose prescribed rates when we pay allowances to our employees, and they're for things like travel or motor vehicle usage, and it's got to do with them obviously spending the money and engaging in business. Julian, what's the story with allowances? They go on the group certificate. Can we just claim them? How's it work?
Depends on the allowance. If it's travel allowance, look, you have to go through the reasonable, I think, rates, and if you're below the reasonable rates, you know, it doesn't have to go in the birth certificate. You know, there's also motor vehicles allowances. Obviously, you have to spend it. There's, you know, just work out. There's no particular rate for that one. You just work out, you know, how much you're expected to spend on that, and then employees can pay your allowance on that. Obviously, if you're doesn't do a lot of travel, that allowance will go up. For example, real estate agents, and if you do minimal, obviously it's lower as well.
Okay, so I've seen a lot of these over the years where there is a bit of travel, overnight travel or the like, and by paying an allowance, we could avoid the need to keep a receipt as long as that allowance is within the reasonable travel rates. So that's a good one for people when they do consider a bit of work travel and reimbursing or paying employees for that work travel. I've got another question here on motor vehicles and the electric vehicles. Julian, I think in your white paper you've identified the value of that electric vehicle. There is a luxury limit or a limit placed on that, and then from there, if it's under the limit, then you can package it and have no tax consequences. Correct?
That is correct. Just make sure, I think the threshold is 89,332, I believe. That is the luxury car rate. So just make sure the vehicle is below that in order to be eligible for this electric vehicle FBT exempt.
Right.
Also, I want to note is if you purchase a vehicle, you know, a second-hand vehicle, and if there was luxury car tax paid on that previously, those are not included, unfortunately. Okay.
So just elaborate. If it was a luxury vehicle previously and you buy it secondhand and it's now under the luxury vehicle limit, then the car is still deemed to be luxury.
That's correct.
Right. I've got another question here, Hayley. If we bought a bit of furniture and put it through the books before 30th of June, we can claim that if it's got business?
Yeah, if it's for your business, yep, definitely. You can claim that. I think, Julian, would that come under the, you were talking about buying equipment under a certain limit, was it 20,000? Is office furniture included in that, or is that just sort of plant and equipment?
If it's for the business, yes, it is included. It's anything that you use for a business per se, really. Any equipment, any off furniture, just anything.
Yeah.
As long as below that threshold of 20K.
Okay.
I got another one here, Hayley. If I get to the end of the year and I do my payroll and I think I might have made a mistake, have I got the opportunity to fix it through single touch payroll?
Yes, you can, definitely. You just need to do an unscheduled pay run and just submit that again through your single touch payroll to the ATO. They would prefer if you do that, and you can't go back these days and amend a payroll per se. So, you know, revert to draft. You actually have to create a new unscheduled pay run and resubmit the new figures to then be included in your final pay event. And just be mindful actually on that. If you've already done your final pay event, and you need to amend, you'll have to resubmit your final pay event for that particular employee as well.
Okay, so it's pretty significant if you do make a mistake, so it's probably important to get it right.
Definitely, yep.
Well, that's the questions I've got. Panel, unless you've got any questions or points you'd like to ask of, excuse me, each of us, I think we can get close to wrapping this session up. Guys, I really appreciate your time and your input into today's session. And for those of you out there, don't forget, we'll make this make this recording live, and particularly the white paper will have some questions and answers for individuals and businesses, which sort of ties this all together in a way that I think is quite easy to follow. And if you do spend some time on that planning, I can pretty well guarantee that you'll save yourself some money and more particularly optimize your outcomes for the end of the financial year. So once again, guys, thank you. For people out there, thank you for attending, and really appreciate your input today.
Thanks, Simon.
Thanks, Simon.